Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. I am on a mission to become the Google Map for hardworking Canadians seeking financial freedom. As all of you would know, my focus is working with real estate investor, and today we have a real treat. I have a longtime friend. I'm finally able to interview him in person. I've bugged him for a whole year for him to be interviewed by me on this channel because I know that he had a lot of gold nuggets that he could share with our audience. But before I get started, if you find our video useful, make sure you give us a thumbs up and share it with all of your friends and hit the subscribe button. Today I have Christian Szpilfogel from Aliferous Group from Ottawa, all the way from Ottawa here with us, and I'll let you do your own introduction.
Sure. So I'm an ex-tech engineer. Well, not an engineer per se. I was talking to Cherry earlier, but from the tech world. And I've been investing in real estate since technically about 2005 and turned pro, if you will, or full-time in 2017. So we run our entire business and our income comes off of our real estate investments. Also on the board of the Eastern Ontario Landlord Organization and the Ottawa Real Estate Investors Organization.
Wow, that's really cool. That's a lot of volunteer work as well.
Yeah.
Yeah.
It is. I mean, I really like to give back to the community. So I'm not trying to raise money. As you know, I'm self-capitalized, and so none of this is about promotion of to try and bring people in from a money management perspective or a money raise perspective. I just like to see people do well.
Yeah. Yeah. This is the exact reason why I have Christian here with us today, because I think through our conversation that we had last year in Ottawa, I found out that Christian has has a really good cash flow management, also run a very efficient property management as well for your own portfolio. So I thought it would be great to have Christian here, and especially in today's market when interest rate is so high, and I know a lot of, even my best friend just texted me telling me that she's considering selling one of the properties because she's cash flow tight, really tight. And so I wanted to ask you the biggest question here in the room, biggest elephant: how do you manage your cash flow? Because a lot of investors are buying based on a variable interest rate.
Right.
At the time, and which was super low. I wouldn't say it's artificially low, but it was super low at the time, and now they're feeling it, and it seems like it doesn't bother you at all. How do you manage your cash flow?
I mean, that's a simple question with a complex answer. But it started off when I started investing originally, going professional. I had to replace my day job income with new forms of income. I had a reasonable sized portfolio at the time, but it wasn't really very well structured. But I understood how to manage cash flow in the first place. But the reality of having to completely rely on that income for our lifestyle was absolutely critical. So I restructured my portfolio at the time in order to do things like get longer amortizations of the debt, right? Or to adjust the revenue profile a little bit in order to be able to increase the NOI. But I focused very quickly on making sure I had a baseline cash flow, even if it was really very simple, in order to support the base of our lifestyle.
Okay, what is baseline cash flow?
So that you can, at the very beginning, it's so that you can live on it. Can you make your, house payments? Can you pay for Netflix? Can you pay for your car and your groceries and
so
all
you kind
of
of
this
do
stuff.
a personal budget.
Yeah. So you start off making sure that you can replace the income you had with your other income in terms of your own personal requirements. But then you can develop a discipline, and sometimes the easiest thing to do or the hardest thing to do, depending on your perspective, is when you're forced into a situation where the ability to put food on your table is really dependent on what you do from a business performance perspective. It really focuses you on getting that optimization.
Yeah.
So I started by making sure that our living expenses were going to be covered, but then I developed a strong discipline about where was the cash coming from in our portfolio. And and then month over month, I do a monthly forecast, just like you would do a family budget if you're disciplined, right? Is you'd say month to month exactly how much cash was coming in versus how much cash was going out, and making sure that was all managed. And then I was relentless with our acquisitions in real estate to see first and foremost, how do I add to the cash flow? So I have a mantra. I buy to add cash flow or line of sight to cash flow. There is no in between. So it's cash flow is my baseline. And every time we do something, I'm constantly thinking, how do we add more and more cash flow? So, and then the second thing is what's your business case around how you're going to improve the property. So usually I'm looking at them in combination to be fair, but my hard requirement is how does this property add to my cash flow either now or worst case after I execute a business case when I'm done.
Okay, so you truly run it like a business, not just randomly buying one property here, one property there, hoping that it's going to appreciate, they're going to appreciate, and then you refinance it. There's a strong business case, numbers are run, scenario analysis are done, there's a budget to it. So I hear all of that. But before we got into the acquisition side of the business, let's talk about something that's more, I guess, more concrete, something that people can essentially grasp the idea and what they can apply today is really cash flow management. You mentioned your tips and tricks on like strategies on extending the amortization. You talk about increasing rent or lowering some of the expenses. But how many months of experience, like how many months of cash reserve, like at the time when you quit your job? My understanding of Christian is that he's like some high roller executive, so I expect that he was at least making 6 figures at the time when he quit his job. So to replace that income is a lot of money. So how many months of cash reserve did you have?
Again, there's a lot of dimensions to this. So you would think because I was a tech executive before that I was rolling in cash and I was wealthy and everything like that. I wasn't. Okay, we're a single income family, and as you know, when you're earning that much money, and I'm not going to get any pity from some people here, but you're taxed to all the heck, and as a single income family, it's pretty serious. But we were also paying for a lot of things. So in reality, when I left my job at the time, I wouldn't say that we were, at best cash flow neutral from a family perspective. So. But when I shifted to real estate and I fundamentally owned my own business, it was a very different mentality. It was, everything I do from here now, it really matters. So it's not like I can rely on my job anymore and think, okay, the cash and the paycheck is going to come in 2 weeks from now. So I think I was guilty as just about anybody else to say at the time that, I know the next paycheck is coming, so I can spend it all right now. So, but when you're in business, you don't know where that money is going to come next, and you have a belief in the revenue stream that you have, but maybe things will dry up in a little while. So my first thing to do, as I was saying, is to get a cash flow performance, enough to at least pay myself, and then to build the reserve.
Okay, so how many months?
So typically, I would run, I'm just trying to do the math really quickly here. I would say I would have a minimum of 3 to 4 months of reserves on a cash flow reserve perspective before I start to feel uncomfortable.
Oh, okay.
And there are peaks and valleys and all this stuff. So I'm routinely refinancing things, right? But what that does is it's largely allocated towards capital for new acquisitions, new renovations. And as an accountant, you'll understand this is that I treat my income statement completely different from my balance sheet. So my assets and my debt are on my balance sheet, my revenue and my expenses are on my income. So when I do a refinance, that working capital is targeted towards new acquisitions and renovations.
So it's being booked against the new acquisition as the new development.
Right. That's exactly right. And so I don't rely on those refinances to support our operations. I separate them completely.
So, okay, that's fair because a lot of people are actually refinancing.
Yeah.
But they are doing the same thing as what you're saying too, but they would refinance the property and then put the money down for like a pre-construction condo or pre-construction home that they don't see any revenue coming in, then my follow-up question to you is, how do you pay for those interest expense? Like, let's say you pull out $200,000 from your existing property and put it into a new project that you need to carry for a year before it would generate any income. So who's going to pay for that 1 year of interest expense on the $200,000?
No, that's the new property. So
then,
I follow the attribution rule on that, and it's coming off the balance sheet of the new property. So I keep those separate. So just like if I run cash flow negative, which is I don't run cash flow negative now, right? So, but if I were, the temptation for a lot of people is to be able to take money off of the refi and use that as a cash flow replacement for their living. I don't, right? So when I do a refi, I don't consider that part of my reserve. Of course it's there if I need it, but there's all kinds of negative consequences from doing that. So we try and make sure that we have cash flow from operations. So that's literally the revenue minus the expenses. And I don't borrow off the income statement to fund my projects, new projects. I keep it all within the balance sheet.
Okay, so here's what I'm trying, like, to make it make sense and accountant makes sense. So let's say you refinance a property. And you pull out $200,000. Instead of having $200,000 going directly into the next property, maybe $180,000 goes to the next property, and that $20,000 is the one that is carrying the property, paying off the $180,000 of interest. Is that right? If I'm understanding it correctly.
That's effectively right.
So this is how you manage your cash flow for new acquisition. So a detailed budget or a detailed cash flow statement would really be helpful. Some sort of forecast would be also very helpful in terms of managing the properties then.
Yeah, absolutely. And again, I just want to re-emphasize that when we're buying a new property, and I mean, yes, there's the attribution rule that you're referring to, but at the same time, we need to think about each property, its contribution to your income, your cash flow, versus where it's adding to your net worth. And I treat each property individually. Most of them are cash flow positive. Some are temporarily cash flow negative, like I do some land banking, to be fair, so they're not generating a lot of money, so they generate some. There may be projects that are under development, and they're definitely not contributing. But if it's a full redevelopment or a brand new development project, it doesn't sit within my, effectively my income statement, if you will, from an operational perspective.
Absolutely.
So I separate those things out cleanly.
Okay, so your existing portfolio is your existing portfolio. It runs on its own, it's cash flow positive. And then when you do refinancing, you don't contribute the whole thing into the new development project. You actually save aside some money for carrying costs as well as interest expense as well. These are great tips as well. I think doing a detailed budget is also the key for all your success, and being able to understand all these numbers with your from your prior experience is something that I think a lot of people are not running their numbers tight enough. I often run into trouble with my clients. Majority of them would come in, show up, do the tax return with us, and complain that, well, we're not getting enough value. But a lot of the time, the numbers are should be run on a regular basis. But people don't look at their numbers on a regular basis. They look at it as the unnecessary evil to file tax return. They don't really care about their numbers. Yeah,
and that's a really good point, right? Is that I see a lot of people, they think an income statement and a balance sheet is something that happens once a year with their accountant, and it's for CRA purposes. We have to have the discipline to manage each of these things on their own. And so I'm really rigorous about, I know my revenue profile across the entire portfolio. I know exactly what our expenses are. We do an operational budget every year. So I'll take the previous year's expenses of actuals, I'll put it down, I'll assume a certain rate of inflation for the coming year, I assume actually flat revenue. So don't assume that I'm going to get rent increases or anything. So I just assume that it's expense weighted. And so then we have a forecast for the next year of exactly how much cash we're getting every month. And then from there, what we do is there are puts and takes. So as you know, sometimes you have to staff up a little bit more because there's some peaks of things, or sometimes for example, I'm taking maybe 10 units out of commission for 4 months as we're doing a turn on that. So necessarily it impacts our cash flow. So when we do that, I've got that full forecast for the year. And so I know exactly where we are. I know how much staff we can have, et cetera. So, and I just don't, if I'm gonna run cash flow negative, which I don't, right? But if I were, I'd still say over the year, am I cash flow positive by the end of the year? So take a short-term bump, right? And then later on, you're gonna have excess cash flows, which compensates for those issues.
Yeah, so you're truly running the real estate portfolio as if you are running a big business or a small business. Whatever business you're running, you should always do that budget, because that exact same process is what I do for my own accounting firm as well. I need to know how many leads are coming in. I need to know all these costs of hiring, how many returns that we have to do. Otherwise, we don't know how many people we are hiring. So we go through that exercise as well. Sometimes the revenue doesn't meet our target, and then so we have to adjust the number of people we're hiring. All these things has to be taken into account. Is there a specific, a specific type of system that you follow to save up for your reserve? Now, I'll share mine with you. Sure. I share with everybody all the time. It's called Profit First. So every time the revenue comes in, it goes into a dedicated account because we charge client on a regular basis. So on a weekly basis, I would go into my bank account, only look at that income account, and it may have $10,000 in it, and I'll allocate 10% to go to my tax account, and then there is a dedicated bank account called tax account, and that tax account is generally hidden from my view.
Right.
That's just so that I know that I wouldn't look at that number and think that the money is mine, because the money is not mine, it's the CRA's money. And then a portion of it would be allocated to a dedicated operating expense account. And then a portion of it would be allocated to Cherry, the owner's account, and then a portion of it will be allocated to something called profit account, which is being the shareholder of the business. Now I do that on a regular basis, and that's how I save up the reserve to I wouldn't say a comfortable place. I wish it could be a little bit bigger, but a comfortable place for us to survive the whole interest rate hike.
Yeah. Well, so the interest rate hike is another piece of this altogether, and I view it a little bit differently. But everything you said before that is why you have a well-run business. And I have a lot of commercial tenants, and I can assure you the vast majority of business don't even do that level of discipline, not even close, but that's why you're good at what you do.
I do that because I had the problem. I was doing exactly what your tenants are doing.
Right.
Happy to do like some sort of like a group meeting with them just to show them exactly what I do. The cost is really the bank statement. The bank account, the cost of operating the bank account. I did it because it was really painful to come up with the tax dollar at the end of the year.
It is.
Yeah.
But it is, and it's also difficult in a lot of cases to predict exactly how much you're going to be taxed at any point in time, especially in real estate, because there's a lot of puts and takes.
Absolutely.
So, I do something similar, maybe just a little bit more simplified, but we separate all of our income and revenue. We run it through a property management company. Now, our property management company just really, for the most part, manages our portfolio. We do some friends and family stuff, but it's largely there. So we manage all of our cash flow or income statement effectively through a property management company. Property management company, if it has excess cash, we hold a certain amount within the business itself. So I've got a float that's at a certain level. So it may not be as investment efficient, but I do leave a certain level of float there that is well above our needs for the next 3 to 4 months. So when we talk about a reserve, that's kind of where the reserve sits. Excess cash beyond what we need from that perspective, we loan to our holding company. and then that goes back into general investment purposes. And then everything that's within our real estate holding companies is, for the most part, I mean, yes, the accounts all accrue or move everything over through journal entries to bring it into the right place, but fundamentally I kind of look at those real estate holding companies as my balance sheets. So that's where the equity and debt really sit.
Okay, that's smart. That's a different way of looking at things for sure.
Okay.
First
To
time
me, it seemed logical.
No. First time I heard that that you would look at the real estate holding companies as
It's basically the balance sheet.
The balance sheet.
Yeah.
And then your PM company as your true profit, like the income statement side. That's an interesting angle.
Yeah. It's a natural way to keep things organized. We use QBO, QuickBooks Online, for our baseline of accounting as well. So by keeping it there, there's no assets per se other than the float, right? That's sitting within the property management company. The QBO is just really clean. And then I have a bookkeeper, and oh my goodness, please get a bookkeeper. If you have to hire your first hire, a good accountant first, bookkeeper next. So honestly, my bookkeeper makes sure that our books are always up to date every month. So I have a very accurate view of where we stand at any point. And then I have, as I said, an operating plan that we recast annually, and then we tweak. Now, as you probably know, with commercial assets, you're audited by the bank on an annual basis. So we just take an excerpt from our operating plan and give it to them because they're looking for that particular property's financial pieces, not just financial statement and everything, but they want to know the operating plan.
Oh, they do.
Yeah.
My bank doesn't ask for that, or hasn't asked for that yet, but who knows. So those are great information and great discussion, because I think people don't put enough focus on their books, and they're feeling the pain, and then we're taking all the hit because they are feeling the pain. And why are you charging us? The reality is, it starts from a regular, disciplined approach to manage your cash flow and also your profit. And it is a business.
Yeah.
You may not think that way, but it is truly a business.
Yeah. Well, a small plug for accountants out there, right? And I know I know people that are, reasonably wealthy and try to do their own accounting and file their own T2s. And I remember what somebody said to me a while back, which really stuck and I think makes a lot of sense, is there's nothing more expensive than a cheap accountant.
Good. That's good. I need to make sure that part of it goes on our website.
Yeah.
And no, I totally agree. But sometimes it's hard, because if our client would say, well, I didn't have any issue last year.
Yeah.
I have actually, for real, I have a client who has a really cheap accountant file without filling out the Schedule 7. So the rental income didn't go through the passive income side for years and years. And I took over and I switched them over and immediately got audited.
Yeah.
But they would have been audited anyway at some point. It's just they were not doing their job to begin with. Yeah. So. Okay, so now that we have enough about cash flow and financial management, because I think I'm the only one that get excited about these things, because he's speaking my language. I wanted to.
But honestly, Cherry, and I we shouldn't trivialize that at all. It is extremely important. So as a real estate investor, you're running a business. There's no any way of thinking about it. It's not just a place to reserve cash or anything like that. Think about it like a business. Think about where your money is going to come from. And yes, there is future appreciation and there's future capital, et cetera, and there's the principal pay down, all good stuff. But we also have to consider what it's doing right now, and we have to manage it like a business and just have that discipline. It really isn't all that hard at the end of the day, but if we run it like a business, we're less likely to get into trouble. And that's why, I don't know if you wanted to talk about interest rates at some point, right, and how to manage debt, but it is part of how you manage a business.
Absolutely. But before I think I'm going to skip the interest rate part, and I'm going to start something that's way more interesting and exciting, which is your project in Ottawa. Last year, when I visited Christian in Ottawa myself, our team actually did a whole full walking tour. We have some footage to share with you as well, and it is an amazing building. in a way that you for sure cannot live there. The building, if you don't mind me describing it a little bit, it's a 7-unit, super old. And I was going to go out to as I was walking out to the balcony, he was like, "Jerry, don't go," and trapped me back in. And apparently it was about to fall down. It's deemed unsafe anyway. So it is something that you are buying. And there's a lot of hype in the marketplace about buying multifamily because everyone is talking about, I need to buy multifamily. And this is the exact same type of multifamily that normal investor would start off. Not number of units. From a number of units perspective, but not the extent of repairs that's required. So tell me how you started on multifamily investing, because that's something that I think a lot of people want to know.
How did I start into it? It was by accident, really. I wasn't clever enough to figure out whether this asset was better than that asset, right? It was just the first thing that I got was a 4-plex, and it was just next to my house. Okay, and then the next building that I bought was a 6-plex, which got me into the commercial lending side, and I had to learn that discipline. And as anybody's ever heard my story before, you'll know that I'm very appreciative of the underwriter at the bank who guided me through the process because it was, I had no idea what I was getting into. It's not complicated at the end of the day, but that's kind of how I got into it. And we've invested in a lot of different asset classes, as you know, but we can stay on the multifamily side. But that's how I got started into it.
Okay, cool, that's cool. So what do you see in multifamily that's like better than smaller unit?
Oh, well, that's easy. Okay, so multifamily, when we're talking at least 5+ units, so that you're in the commercial lending side, is just like every other commercial property, whether it's light industrial, office space, etc., its valuation is driven off the net operating income. So revenue minus expenses is the net operating income. And so the value of the building is proportional to the increase that you do on that net operating income, or NOI. So for me, it's critical because it makes for a deterministic business case. So if I buy, say, a single family home and I improve it, I'll get some value in there, but it's not very tangible. It's very subject to the retail market and whether somebody's willing to buy it. On the commercial side, because the valuation is primarily driven on the income, if I can do something to increase the income, I increase the value of the property. And I really like deterministic investments. I like to know I'm going to buy this, I'm going to do this, my income is going to be that, I'm going to have a new valuation of X, which is going to increase my balance sheet, right, or expand my balance sheet, as the financial wizards like to call it. And at the end of it, because I've increased the income, I know that I'm going to get cash flow when I'm done.
Okay, so my understanding of what you just described is that you like to buy it because it's more like a predictable, something that's more controllable by you, because you can do something and essentially see the result being reflected immediately, rather than doing something with smaller investment. You do a lot, it may not even make any impact, and you could still make the same return.
Yeah, the financial outcome is predictable.
Yeah.
That's primarily it. Now there's some puts and takes in the market, like cap rates can shift around and so on, but for the most part, it is predictable. You can write a business case when you buy it, know what you're going to do, know what your new revenue profile is going to look like, know what your new expense profile is going to look like. You know exactly what the building is going to be worth, right, within plus or minus 5% of when you're done. You know how much cash it's going to generate and add to your operations, and you know how much net worth you're increasing.
I feel like I'm talking to another accountant. Okay. Back to your exciting property, because last year we toured that property, and your plan was to turn it from 7-plex to 12-plex, and you had a little bit change of plan. So what's the status of that property right now?
So we're probably about 2-3 weeks from exiting site plan control. I've literally just signed off on the development agreement, which is called the DAR, and so we've signed off on that. So at that point, we've got our GC, so we're outsourcing this for the first time. So we've done all in-house GC work on all our previous construction projects, but we're scaling to a point where it's just not sustainable. And I don't want to hire GC staff within our business. Our business is making money, not building product. So So that process, so we've got our GC ready to kick off next month. So
GC is general contracting, for those
Right.
of you who don't know. So when did you purchase this property?
Oh, jeepers, 2 years ago.
2 years, 2021.
Yes.
So during pandemic.
Yep.
Okay, you bought the property during pandemic. Were they all tenanted?
It was tenanted, yeah.
So set of tenants, because there is a seven. Did you say sevenplex?
Yeah, it was a 7-plex.
Yeah. So but when I visited the property, I think there was only one person living there.
Yeah, and then now there's nobody living there.
Okay, so
Yeah.
kick everybody out, not kick, like
So-
it needs some love, the building.
The building has structural issues, as you pointed out
Yeah.
earlier, right? So something that we don't do is I do not force tenants out for not a good reason. So if the building is otherwise sound and we're doing unit turns, we'll wait for the tenants to naturally move out. I don't want to affect somebody else's life negatively like that. If I
Yeah.
was in their shoes, how would I want to be treated? So that's the way I think about it. This building, on the other hand, so the original plan was that we were just going to renovate the 7-unit building, and the business case was reasonable. So we were going to probably make about a $500,000 profit by doing that. The IRR on that was just about 31% on that. It would have been a faster turn, right, which was one of the reasons it contributed to a better IRR. But the internal rate of return.
Yes, internal rate of return. So not everyone knows what IRR. That's how I feel like when I talk to you. Someone is actually more educated than me on using these acronyms than me.
I doubt that, but so it's a fair point to just
Yep.
discuss, just to do a quick segue into IRR. So a lot of people know cash on cash return.
Yep.
They understand their price per unit. They know these things. And a lot of people use an annual rate of return, but it doesn't take into account things like inflation. And it doesn't take into account, and I apologize for this, but the working cost of capital. So the way any good business is run is we look beyond that. And when you're comparing business cases, so several projects, which one is going to be the best business case? You compare them over the same interval, so an IRR over 5 years, and I use 5 years as my benchmark for an IRR. That's a key metric that most people should use. Now, my benchmark on that is I need to do at least 30% IRR for the business case to make sense. Otherwise, I don't get into it.
So, I mean, remind me, because I don't have ChatGPT right now. So IRR is essentially the cost, the expected return, at least minus the cost of capital.
Effectively, yes.
Yes.
So it's, you can also look at it as taking into account inflation, right? So because I'm going to get technical for a second, but it's a net present value of future cash flows, including the refinance.
So for those of you who don't know IRR is, ChatGPT.com can help you.
And Excel has a function, so you don't have to do the math. It's actually simpler than it sounds, and it's a good function.
But you have to input the expected inflation rate and everything.
Or your working cost of capital.
Yes, that too. So,
to get back
30%
to the
is
story.
crazy.
Yeah, so but that's my hurdle.
Yeah.
Okay, that's what I know, and I have enough deal flow that I can be picky about it. So that's what I'm always looking for when we have something where we're fixing it, improving it, etc. So that's the return I'm looking for. On that particular project, it was about a 31% IRR. So in a very, again, simplified terms, think of it like a 30% annual return, but adjusted for inflation. So that was the benchmark. So when we were looking at it, we had structural engineers go through the building, and it became pretty clear that there were some fundamental structural issues that I was worried that as we renovated, we were just going to have to end up doing a lot of those expenses anyway. So, digging in behind, fixing structural issues. So it would have actually collapsed my business case a lot. It put a lot of risk on my business case. So then I asked my architect, I said, well, what if you had carte blanche, and what could we do? And he said, well, we could easily get a 10-unit in this, because there was a lot of dead space in this building. Like, probably 30% of the units were unusable to the tenants, and they weren't laid out very well. They were just kind of cut into the old building.
Yes, that's because, how old is the building?
1901, and it was last renovated in 1929.
Yeah.
So that says everything right there. Right?
Yeah, absolutely. That's why I can't go out to the balcony. Yes.
That's right. Structurally, we were concerned about the balcony, but there was other parts in the building that had concern. So because that made a difference in the business case, that's why I was looking for an alternative plan, because we were looking at something simple originally. And when we looked at it, he said 10, and I said, well, what are your assumptions? Because some of these units don't look like they're going to be very functional. And he said, well, I have to take into account all the load-bearing walls. I said, what if we get rid of the load-bearing walls? So then he relayed it out and said, I could do a 12 unit and it would be very comfortable. It would all be logically laid out. So we had the choice now, 7, 10, and 12. So I ran a business case on each of those to see which of them gave me a better return. And the 12 unit building in the end had about a 45% IRR. Okay, so that's why I was saying you got to compare each project on the same time frame. So now I'm looking at 31 versus 37 versus 45. So I said, okay, well, this is easy. And you know what? I know I'm probably going to end up doing more work than I thought. So that 31% on the 7 unit renovation might have been fictional.
Yep.
Whereas it's much more deterministic on the 45%. Now, it did extend my timelines, right? It did mean my carrying costs were higher. It did mean more overhead in terms of things.
So 2021 was the purchase day. Now it's finally getting to site plan approval, which we're in 2023. And next month, the GC is starting to go in to do the work. So that's the 2-year carrying cost.
Well, it's going to be 3 in total.
Well, then there is the building phase, that's 3 years. And then assuming there's no delay, then 3 years later, then you will start renting out to tenants.
That's right.
The reason why I wanted to lay out the entire timeline is that sometimes when we get into projects, we weren't really thinking out loud and planning it out. Sometimes people don't even know what they're getting themselves into. So I feel like it's important to say, hey, like, sometimes some projects, when you undertake them, you like budget for the time delay. So how much is the renovation cost now that you're removing all of the load-bearing wall?
Yeah, it's a good question. So we originally viewed it would be somewhere between 1.5 and 2.5, and as Murphy would say, it'll end up probably closer to 2.5 million.
Okay.
So so it's a little bit more expensive than what we originally planned, but the business case was written on the outer bound, so we assumed 2.5, and I still have contingency beyond that. So, but so that's a construction cost, and then there was a purchase price of about 1.6 for the property, and the value of the building will end up being in the order of 5.4 when we're complete.
Nice, really good. Return to 45%. All I could remember is the 45% IRR. No. Like, I mean, looking at just the percentage of return on its own, it totally makes sense. Part of it is also your approach to the whole project that I have a lot of respect on.
Thank you.
Because you're really running a tight ship, running a proper business plan for it, and rather than just wing it. And I think that wing it, and I think that's just really what majority of the real estate investors out there are doing. I think having that plan, adhering to your plan, and running numbers are something that we all can learn from.
It's really very important to have that discipline. We're talking about a lot of money here, right? So, you know, if it's a small amount of money, if you're off by 10 grand or 20 grand, you can absorb it in different ways through your lifestyle. We're talking hundreds of thousands and millions of dollars here. You can't absorb that in any other way. So the ways that I do it is, one is discipline around the business case itself for this, but we also ensure that we have other backstops. So I have a lot of contingency. So, for example, I did a bunch of refis in the first half of this year, right, to backstop this. So I have a lot of working capital I hand, more than I need, much more than I need for all of the renovation work and so on like that. And that's just part of risk mitigation overall. So, yeah, that's a key thing.
Great point, because a lot of the people, myself included, there are some times that I got offer for loans and I just turned them down. Reasonable A lender type of loan, and I didn't realize that, hey, like, I could actually use them, or at least sign up for them for preparing for my rainy days. Sometimes it's I don't think you ever need to refinance those property to pull out the money. It's just in case. I think that having that just in case mentality is extremely important.
That's right. So it's better to have the cash than to not have the cash.
Yeah.
And you never know when there might be a bank liquidity issue. There might be, painful points in time with respect to interest payments that you have to make. So I get the money when I can get it cheap, and I keep it on the sidelines per se, and I use that money and I earn money in different ways with it. So it's not just sitting there, devaluing, right, with inflation. So we're doing other stuff, but it's liquid. And so we do that. And then the other thing that's really important in the way that we do stuff is, while any single deal might be high ratio, our portfolio never runs above 65% debt to asset ratio. So take up all your debt, take up all your assets, 65%. That's the number that I don't go above. And some people would say it's more efficient at 75%. The reality is I run lower than 65%. But what that does is that in the event of something really bad happening, I have money squirreled away in different properties that I can pull out to kind of save us if it ever came to that. So that's a key thing. And then what I try and do is at least take some of it out as cash right now when money is relatively cheap. Right, so, for example, we were doing some refis here, but I was in a rush for them, so I just waited for the dips in the when I could get money relatively cheaply. So I did a bunch of refinances on some of my larger multis where I pulled stuff out and I'm paying only 3.85% interest rate.
I read that message.
Yeah,
in the post, yes.
Yeah. But with a 40-year amortization, so that maximizes the cash flow, and so.
That's awesome. So, I was going to ask, I network with a lot of entrepreneurs. I was going to ask you if you were scared at all, but I think I don't have to ask that question. Like when you look at the number put together for your budget for like 1.5 to 2.5 for this particular property, I always wanted to ask, like, are you scared, like, at all, looking at those numbers?
Not anymore.
Not anymore.
So I've gone through, my very first construction project was probably about 6 years ago. And I did not build as much contingency as I did. And unexpected things happened. I had foundations that collapsed. I discovered joists that had been cut. We had to do a lot more work than what I originally planned. And I didn't build as much of a cash budget and contingency fund as I should have. And I was doing it all with my own money. I didn't do a construction loan. I was trying to finance this out of our HELOCs and from various forms there. And in hindsight, I learned that you need to have, no matter how much money you think you need, set a big chunk aside, still go for the construction loan, get that financed, and use that extra capital as backup. Because even when you go to do the refinance later, you might not be able to refinance out 100% of the construction loan. So you still need some of that money to be able to pay that down on that side. So I've learned that it's better to have a lot of extra working capital on the side, just in case. Because that first project had a lot of sleepless nights. I was writing checks. There were days where I was writing $50,000 worth of checks every day for like a week. And I was thinking, this better end because I'm going to run out of money.
Okay, so as successful as Christian is right now, there are sleepless nights. So it's not like just exclusive to brand new investor out there or newer investors out there. So, so today we share a lot of tips. I mean, I'm very grateful for all the tips. A lot of them can be apply and adapt to regular business operation as well. I don't think it's just real estate investing. So all you were mentioning before, all the tips that you were talking about, it's all applicable to business owners as well. So I very grateful to have you here. Is there anything that you want to share with you? How do people in the audience, if they ever want to reach out, have questions, how do they reach out to you?
Sure. So you can reach out to me. I'm on social media a lot. So my name, Christian Szpilfogel, and our company is Aliferous, the Aliferous Group. It's a registered trademark, so it's very unique. And so you can reach out to me through any of those means. I'm always happy to help people out. And I'm also on Oreo. So just a quick plug for the Ottawa Real Estate Investors Organization. I think a network of professionals where you can learn from each other is really very helpful. The Ottawa Real Estate Investors Organization, or oreo.org, is a not-for-profit club. The board members don't take any salary. We're all volunteers, and all the dues really just go into our facilities costs. So it's really all about members helping members.
Yeah, excellent, excellent. If you like our video and like our tips, make sure you share with anyone who can use some help today as well from today. Thank you so much.
It's my pleasure, Cherry. Always a pleasure chatting with you.
Yeah, thank you. Until next time, thanks for watching.